I expect that for at this time. So you will have something called like preparation as well as something you have for your group report already. Okay, so now I will share with you, and I expect that like the exact content that I want you to have in your group projects, okay, and your real estate projects. Okay, what is the other thing, including like except for the real part, right, the main part. All right, so I will share with you a sample of the table of content that I want you to have, right, at least in the group report. Okay, so just give me a second. I will share with you 2 examples, and then this is your job to take note. All right. Okay. Here, right. Share screen. Where's the file? Okay, so here, I think that this is the file. All right. So clearly, right, this is what I expect from your report. I just see some message right here. Is it all right now? Okay, so firstly, there must be 7 parts. Okay, firstly, the thing that you need to have is that the scope of the report. What is it? Okay, the scope of the report is to tell me what is the purpose of your report, right? What is the purpose of making this valuation report, right? Is it from the point of view of the buyer? Is it from the point of view of the investor? Or from the point of view of someone? Okay, you need to make sure to include that information here for the purpose, and then for the background of the project as well. Okay, and then the date of valuation, it should be like optional, but it is better if you could include it here. Okay, that is for the scope of the report, firstly. And secondly, right, after you come up with the scope, right, the purpose, you jump into the discuss, like the introduction. Okay, clearly, right, you should have this kind of introduction every time that you complete a kind of report. Okay, so what is the valuation report that you have? Okay, what is the name, right, about this? So what is the developer, detailed information about this time, so you will have something called location, layout, facility. So anything that you have related to this real estate projects that you think is necessary for your valuation. So just put it here in the introduction. Okay, right? So after you come up with those information, it's now time for you to think about your valuation method. Okay, so basically, I think that student may choose market comparables, right? The first valuation method that you learn in the second section with Dr. Duck, okay? Because this is quite simple. But the thing that is different, like difficult here, is that how can you find out the comparable, okay? To find out the comparable, so that kind of comparable must be at least similar to your valuation project, but at what point, right? Location, or layout of facility. So at what point? So you need to make assumption. Okay. So from that comparable, you can come up with the enterprise value of your valuation projects, and then from that you can divide it by the total square per meter of the whole building. So you can get the per square meter, the price per square meter for that projects that you want to value. Okay. Right. So here this group, they choose to value this project using 2 methods of the here away only the market comparable. Okay, and here, right, when you can choose a market comparable, making the assumption, and then give me your rationale. So that is a part 3. Okay, and then part 4, right? Part 4 should be somehow, let's say somehow it is appear first before part 3. Okay, market situation. All right, so if the valuation projects of your right is your chosen is located in district 2, so you need to examine about what is happening in the real estate market in district 2. Okay, including the housing demand, right? Do people have any increasing in demand for housing or apartment or like the other things, or is there any macroeconomic factors that would affect to the development of the real estate in this area? Okay, because that will have effect on how you can make the valuation. Okay, this is called the intangible factors, right? And then here, factor affect the growth, right? So this means that you should have the information on the market of the real estate, right? Overall around Vietnam, and then in the location of the valuation project as well. So that's market situation. Okay, so after you come up with introduction about the projects, about the market situation, you can come up with what is called the comparable, right? The one that you choose to value the projects. And here, this is methodology and then data collection. Okay, so what is your assumption? And then what value that you use to estimate the like the value of that project, including the valuation method, right? How can you come up with that number, right? What is the step of calculation, right? Remember, for me, this is just a Word file. Okay, you need to have an Excel file as well, right, to show me the detail of calculation. Okay, so two files submitted at the same time. Word file to show me the report, right? The thing that you have from your Excel file as well, the Excel file. Okay, and right, remember we still have the video of the presentation. All right, so many things to do, right? Okay, it means that you need to start to do from now, right? Especially for the part of scope of a report and then introduction, you need to finish, right? Otherwise, there's too many jobs, too many tasks at the end, so that will that will affect to your result. Okay, and here, right after you discuss the methodology data collection, you come up with the result. Okay, so from that estimation, so what is your estimation for that project, right? And then compare with the current market price. So is it undervalued or overvalued? Okay, obviously you will see that the result that you have is overvalued. Okay, sorry, it's undervalued. It means that the current projects that you do, right, compared to the current market price, it should be, it will be undervalued, right? Because you know that in Vietnam, right, people or the supplier, the buyer, the seller, they try to push the price of the real estate projects. Okay, and you look into that information, so use the research, so you will know that. Okay, so it should be, it's not all the cases, but I, based on my experience, for the estimation number that you have, so it tends to be lower than the current price, okay, of that similar projects in the market. Okay, and here the last one also important is the limitation. All right, so here for the result part, right, regardless of what you have to discuss about your result, but you need to include what is called a risk analysis as well. Okay, risk analysis, because why? Here you see the word assumption. Okay, it means that you make valuation based on your assumption, right? So if the market changed, right, if the growth of that project changed, so what happened to your the price of that project? Okay, what happened to the value of that project? For example, if we talk about the market growth, right, if due to COVID-19 it is under your expectation, so what happened to the price, right, of that project, including the price of apartment, the price of a plot, or the per, like the price per square, okay, for that project. Okay, here, right, so as you learn about the risk analysis, so take note for me, sensitive analysis and scenario analysis. Okay, I think that you may learn about this previously for that topic 3 or maybe topic 4, I don't remember clearly, but I think you learn about scenario and sensitivity analysis. Okay, it means that if you change one thing regarding to the revenue or maybe to the growth of your cash flow, so what happened to the enterprise value? Okay, right, so here that is an example about the table of content, right? So I will share with you another example for the second table of content that you may take it as a reference. All right, so here I see from the other class, the previous class, so usually they will evaluate the projects using both approaches, the cost approaches and then the market comparable, right? Why? Because the market comparable is very simple, right? The thing here that is different is that how can you choose the comparable, right? The rationale, right? The words that you use to back up your selection, and then the story that you tell to, let's say, to make people believe that this is a suitable comparable. Okay, but the thing here that I think more like difficult is the cost approach, because it's related to the cash flow. Okay, so here for the cost approach, it means that you compare, right, the cash flow generated from that project from year, right, to the like from years to year, and then discount that cash flow back to the present and compare it with the cost of building that project, right, of building that real estate project. So what is the enterprise value or the net present value of that project? Okay, so that is a cost approach similar to the cash flow approach. Okay, and here I similar to the previous table of content, right? You should have here the scope of the report, including purpose, right? And valuation date if it's optional, background, and here what is called the information of the projects, right? Including conditions, services, or anything else. Right, for this group, they include a part called Lego and then title matter. Okay, this is optional, but you know, again, if this information is necessary for you with the thing of market comparable or anything here, so you should include, otherwise close it. Okay, so this group, because they think the legal title matter, right? Because they should use some information right here to back up for their selection. So that's why they include this part. Okay, and here, right, this is the current market situation, including like town, country planning, and then restriction, right? The restriction here, it could be the legal restriction, right? It's related to the paperwork, right? The legal agreement between the government and then the company that construct the house, okay? The restrict services. Okay, so here, and then limitation and risk. All right, so overall, we should have like these part on your group project. So start to researching from now, okay? If you choose market comparable, so start to search for the market comparable, right? Including why you choose that, okay? Why is there any rationale for that? And you know that, right? Because there's nothing called similar projects. They just pretty similar to each other. That's why when you come up with the estimation, you need to have the adjustment, right? Maybe you add up around like 10% increase or a decrease of 10%. This is because of different location, for example, or like different features or different condition. Okay, so here, right, that is something that you need to think about for the group valuation. All right, so any question for me before we move to the next part? How many projects do you think is most suitable in the market comparable? All right, so for the number of projects to be in the market comparable, I think that the best is 3. Okay, 3, and then that is a better number. 4 is also better, but you know that to find 4 comparable is quite difficult, right? It's pretty difficult. So 3, I think that is the ideal number for you. Okay, 3 comparables. Okay, so any other things, any other question from you, right? Maybe later Dr. Kim has got more about, okay, so you can ask her for more information, but I just shared with you about the table of content, right? And then why I don't share with you the sample, because I want you to be creative, okay? Because when I just share with you the sample, so you tend to rely a lot on that sample, and then that may make your paper to be less creative, and then that's why you cannot expose your creativity. Okay, so here just some of the hint for you, like the table of content, the thing that you should include in your report. Okay, the evaluation report. Okay, right, just try to finish for the first part, like at least section 1, 2, 3, and 4, right? The current market situation, you can research clearly on the internet about Vietnam market situation and write the property information, right? So start to writing for this part from now, okay? Right, so is anything else that you want to ask me? All clear, right? Okay, stop share. So maybe I think that you just take a screenshot for what I just shared with you and then think about that and then try to assign the work to the member. Okay, make sure that you finished the group projects. And then you know that there are many things that you may encounter during the time that you complete the report. So just ask me, okay? I will give you the advice. All right, so anything else? Because we don't have much time, so let's jump into the discussion of today's revision. Okay, we have 2 exercise to discuss today. All right, so remember group 1, 4, and 6, please send the information of your projects to me immediately today. Okay, otherwise you get a reduction in your score. Okay, please. Okay, so let's start today's section. We have 2 exercise. All right, so here, let me share the screen. 2 exercise including 12.11, right? So maybe I think that Dr. Duc discussed something related to problem 12.11 in class, but he haven't explained to you in details how can you come up with like the answer for each of the sub question, right? So that's why I will like explain more about 12.11 today, including 12.15 as well. Or just send you the email. Okay, right. Thank you, Khương. Right, just only the group leader send me the information of the projects. Right. Okay. So problem 12.11. For this problem, we have some small exercise. Okay. Right. So previously in the section with Dr. Đức, you learned about the cash flow valuation method. Okay. Simply, I told you many times is that the basis of valuation is that you just based on the cash flow, right? You just estimate, you just forecast the future cash flow, the future payoff of that project, right? From years to year, discount it back to the present using a discount rate to reflect the risk, and then that is the value that you have. Okay, right? So here from chapter 12, you learn about the cash flow approach, and then you use the cash flow of the projects from years to year, including the terminal cash flow. Okay, so terminal cash flow is important for your real estate projects. Okay, because that account for example, if you use the cost approach, the terminal value is important, right? Because you know that you can forecast the cash flow from year 1 to year 5 only, but you know that after year 5, okay, we need to have some assumption to the growth, right? And then that's called the terminal cash flow. And then, you know, you should include what is called the intangible value as well. Okay, not just only the tangible value in the cost approach. Okay, so 12.11. Let's see. Okay, just give me a second. All right, so saved. Here solution. Chapter 12. Okay, chapter 12. We have something. All right, so 12.11, we have up to 1, 2, 3, 4, 5, 5 questions, 5 sub-questions. Okay, so one student, please. Sub-question A for problem 12.11. Okay, any volunteer for that question? Otherwise, I will call you randomly. Okay, yes, Thảo Nhi, right? Thảo Nhi. Okay, stop share here.
Okay, so I will share my screen.
Okay, Thảo Nhi, which group is it?
I'm group 2.
Okay, group 2, right.
I'm sharing my screen. You guys see my screen?
Yes, we can see your screen clearly.
Okay, this is the problem 12.11, and so I will do the sub-question A. The sub-question A tells us to beginning with cash flow from operating activity, calculate the free cash flow to on debt and equity capital shares for fiscal year ending in 7, 8, and 9. Okay, so this is my answer for sub-question A. So beginning with the cash flow from operating activity, like the question asks us to, I put here the cash flow from operating activity through 3 years. Then if we want to calculate the free cash flow to on debt and equity stakeholder, we need to have the free cash flow from operation to on debt and equity stakeholder, and we minus it with cash flow from investing activity. So the free cash flow from operation to on debt and equity stakeholder can be calculated from the 3 variables that I highlighted. We use the cash flow from operating activity, and then the interest paid net of tax. The interest this amount I calculate by this in the question provide us with the tax rate at 40% here. So I used 40% to calculate the interest paid net of tax through the years. This I provide the equation here. So 1 minus 40%. And then I have the interest paid net of tax through 3 years. So cash required for liquidity, like this, I have it from the cash flow, the statement of cash flow provided. So when I have this, I can compute the free cash flow from operation to on debt and equity stakeholder by sum of these three variables in the year provided, and cash flow from investing activity. Then I sum two of these, so I have the free cash flow to on debt and equity stakeholder.
Okay, right. Thank you, Nhi. All right, so just say there, right? I need to make sure about the interest paid on net. All right, so can you go to the row of interest paid, net of taxes, right? The row, right?
Here,
This one,
okay. Here.
Okay, this line, okay. So 8,021. Where does you get the number? Okay, I see 8,021. So what is the number right here?
Okay, this is the interest pay. Okay, so I will find it.
Cash paid during the year, right? Scroll down a little bit. I see the number.
I don't see it. I'm sorry.
Ready. Okay, right here. Cash paid during the year for interest. Okay, this one.
Yeah.
Okay, so remember for me, right? This is the net interest after tax. So this is the cash paid during the year for interest. So this is interest expense in terms of cash payment. So it means that in this case, net interest after tax, you need to minus the amount of tax of 40%. Okay, so that's how you can come up with the information about the interest payment to estimate the cash flow. Sorry, can you scroll up a little bit? Okay, scroll up. Okay, to question A. Okay, just scroll up to your result. Okay. Your estimation. Okay. Here, right? So net interest paid of net of taxes, right? So interest paid after tax. So that's the number that is required for you to estimate the free cash flow from operation. Okay, the free cash flow from operation. Okay, from operation to all debt and then equity stakeholder. Okay, so which means that when we have this cash flow, and then this is the free cash flow can be distributed to the debt and then equity stakeholder in terms of operation cash flow. However, that we need to consider the investing activity as well. Okay, so the investing activity, you have the information already from the cash flow statement or the cash flow for investing activity, right? You minus that cash flow needed for the investment, and then the remaining amount, that is the free cash flow to all debt and then equity stakeholder, right? So that is the information that we have. Okay, right. I think that is good. Right, thank you, Nhi. So let's continue with question B. All right, question B is also similar, but they ask you, okay, let me have a look at question B. They can ask you to estimate the free cash flow for common equity stakeholder. Okay, so just only for the common equity stakeholder of this company, right? Not like the debt holder, but only the common equity stakeholder, right? The one that buy the stock and then the shares from the company. Okay, and then we also have the formula in the textbook and then in the file, right? The slide presentation to show you how can we come up with that cash flow. Okay, so one student, please present the answer for me. Okay, some of you raising the hand right here. So I will call someone that I haven't called your name, Khánh Linh, right? Okay, maybe Khánh Linh, the first one on the list.
Okay, let me share screen.
Okay, Khánh Linh, B 12.11.
Can you share my screen?
Yeah, we can see your screen.
Okay. Question B is ask you to calculate the free cash flow for common equity shareholders, and we based on the similar process like the question A, and I put on the right hand side here. But the difference in this process is that in terms of the operating activity, we took the net interest after tax out, and the other thing is that we add the financial activity in, and this includes three figures that I put here in. They are short-term borrowing, long-term borrowing, and the payment of long-term debt and capital lease. After we sum all of these figures, like the question A, and finally we got the free cash flow for the common equity stakeholders.
Okay, right. See what you mean. All right. So in this case, right? Thank you, Linh. Right. So just stay there. Okay, so here, this is just only the free cash flow to common equity stakeholder, right? So it means that you need to care about that is what is called the increase, net increase or decrease in cash. Okay, so I will explain more about this, right? But I just need to make sure that you guys have like the exact calculation step right here. And this is important for your final exam, right? The question will be pretty similar, right, for the calculation part, but maybe it will be more complicated for the rationale question, right? The short answer question. Okay, so here, right, less the investing activity. So this is a cash flow from operation for equity stakeholder. And then you minus the cash flow needed for investing and then for the financing activity. So the remaining one, this is the cash flow for common equity stakeholder. Okay, so all of this information you have is from the cash flow statement of this company, right? Given the cash flow statement, you will have information for the cash flow from operating activity, cash flow for investing activity, and then cash flow for financing activity. Okay, so just follow the text like the what is called the formula, the step right here to estimate the free cash flow for common equity stakeholder. Okay, I will explain more about this later when I jump to the discussion. Okay, right. Thank you, Lynn. So I think that's pretty similar to the previous question A, but here just only the difference in the calculation step. Okay, thank you, Lynn. So let's move to question C. Right, symbol one. Symbol one. So question C is pretty simple. So I think we should ask someone to answer C and D at the same time. Okay, C and D at the same time. Right. Anyone C and D at the same time? Any volunteer? Just try your best. Okay, try your best. C and D. Okay, C is pretty simple. So I want to hear your answer for D, right? For D. All right, so if no student raising the hand, so I will have to call randomly. Some of you that I haven't called your name.
Sorry, teacher. Can I answer?
Okay. Yes, of course, Min, right? Okay, yes, Min.
Yes. Okay.
Min, your name is, what is the family name?
Just Lemming.
Okay, Lemon, right? Family. Lemon.
Okay, I will share my screen.
All right. Lemon. So I just take note here.
Okay. In the question C, I will calculate the free cash flow for common equity shareholder by recording, and in here we can calculate by just using the cost related to the common stock, and here we only have one relate to it is the process from sale of common stock. So here is free cash flow to common equity shareholder.
Okay. All right. So C is pretty simple, right? So,
Yes.
right, as you, right, thank you, Man, right, just stay there because you need to explain D as well, right? So you can see here, right, that is just another way for you to estimate the free cash flow to common equity shareholder, right? For question B, we base on what is called a cash flow from operation and then minus the net increase or decrease in cash, and with the like cash flow from investing and then financing activity. So that's how you can come up with the free cash flow to a common equity, right? But if you have the number like the cash like proceed from sales of common stock, so it means here that is like when you sell the stock, right? When you sell the stock in the market, and then like the shareholder buy that. So proceeds from sale is the money that you receive from the selling of the stock in the market. So that is the cash flow available to the common equity shareholder as well. Okay, because that will be distributed to them like as dividend later. Okay, right. So that is what we call the free cash flow to common equity shareholder. Another way for you to estimate based on the proceeds from sales of common stock. Right, and then we have like the upcoming one is question D. Okay, question D.
Yes.
What is question D? Yes, can you explain?
Oh, that's question D here.
Okay.
Question D, I will answer. Why do the free cash flow to all debt and equity capital stakeholder for this sporting good change so much from year to year? First is In 2007, the firm grew by investing in new stock assets, but finance more of the growth with cash with from operation construct allowance.
Mm.
Here, yeah,
Okay, just scroll down to the investing activity and you can see. All right,
yes.
so capital expenditure right here is a lot, right? From a year 2007, right? This capital expenditure is up to $191,423. Okay, that is for the capital expenditure. And then we have purchase of corporate aircraft. So that is kinds of investment in like the equipment and then the machine for this company in year 2007. Okay, right. And yes, continue, Nhuận Minh.
In 2008, the film used longer money uh, to portray of the Gold Galaxy and Chick Sporting, and that's
Okay, right.
so.
Okay, so I see what you mean here, right? So it means that later on, when the company finished with the investment in the corporate aircraft and then like the capital expenditure, so later year, right, they decide to purchase the Golf Galaxy. So this is a kind of merger and acquisition transaction. They want to expand the business, and they also purchase the Chick Sporting as well. Okay, that is for them to enlarge their product line and then to extend the market of the product that what they want to sell to the consumer. Okay, that's why they spend a lot of money for the investment activity in 2008. Okay, in terms of the merger and acquisition transaction. All right, so that's why you see that the investment cash flow used in investment activity is a lot in 2008. Okay, right. And what about 2009?
2009, they just use the primary cash from operating to financing growth in the store, and he don't need anymore for Gold Galaxy and Chick Sporting Good.
Okay, right. Okay, thank you, Minh. So clearly, you can see that, right, this is the kind of process of development for the firm. So firstly, they spend a large amount of money to purchase the corporate aircraft and then some kinds of investment in the capital expenditure, right, to enlarge the business. And later on, right, they extend the market into like through the purchase of Golf Galaxy and then Chick Sporting Good. So it means that this is a years of investment for them. And later on, right, they just develop the firm, they develop the product based on the previous investment of Golf Galaxy and then Chick Sporting. That's why the money here is zero for this project, right? Because we just pay off the money in 2009. But later on, right, the company just need to spend on capital expenditure to maintain the business, right? To maintain the level of the fixed assets. Okay. All right. So, right, as you can see here, we have the investing activity, right? The net cash yield in investing activity fluctuated a lot from years to year. Okay. It means that in year 2009, we need to use a lot amount of cash from operation to finance for the purchase of Golf Galaxy and then Chick Sporting. That's why we have a negative right here. This is like the cash that we pay out. So that's why this is a negative number. And then in comparison with the cash that we have, right, cash flow into the company. And then at the end of the day, we have the cash, right, available for this company is negative, right? The cash flow for shareholder and then cash flow for debt and then equity holder is negative. Okay, right. Okay, so I think that you did have some idea here. Thank you, Minh.
Yes.
All right, so that is for question D. Okay, why? Then I also explained to you about why the free cash flow to debt and equity shareholder is different and then it changed so much from year to year, right? Just look at the the cash flow statement to know about the investing activity so you can answer this question. Okay, and also they ask you why do free cash flow for all debt and equity capital stakeholder, right? Why is different too much from the cash flow to common equity shareholder? So clearly, right, the way that we estimate the free cash flow to all debt and equity stakeholder is different with the way that we estimate the free cash flow to common equity shareholder. Okay, including here we include the cash flow for investing activity and then we include the cash flow for financing activity as well, right? This one, okay? But for the cash flow to all debt and equity, we don't care about what is the free cash flow to like cash flow for financing activity, just only the cash flow for investing activity. And why that is called the difference, okay? Right, so clearly, right, I just explained shortly for question D right here. And then this is the question that I expect from you if you have this question in the exam, okay? You need to base on the information that we have to explain for the cash flow activity of the firm, right? Why we have a negative right here? What is investment activity that we have that make the cash flow to be negative, okay? Clearly, right? Purchase of something called the Golf Galaxy, the merchant acquisition, and Chick Sporting, so that will make like the investing activity require a large amount of cash. Okay. All right, and then additionally, we can see that when we estimate the free cash flow to common equity shareholder, this is a negative number, right? This is a negative number. So is it a bad sign for the company? Is it a good sign or a bad sign for the company? So do you think that a negative free cash flow to common equity shareholder is a bad sign, right? It's a bad signal for the company, is it? Anyone here have the idea for my question? Have any answer for my question? Right, right, you see that negative, right? The free cash flow to common equity shareholder is negative. So is it bad for the company? Right? Is it bad for them to have a negative cash flow, or do you think that this will destroy the value of the shareholder because they didn't receive anything called a positive cash flow to the shareholder? Okay, so that is also the question E, right? Does that imply Dick Sporting Good is destroying the value of common equity, right? Because of negative free cash flow to common shareholder. Okay, so what do you think about this question E? Okay, anyone here volunteer for this question E? Tell me, and then I will call you. Otherwise, we'll have to call randomly. Okay, no one want to answer this question. This is E, right? So just let me know what you are thinking about. E, okay, so Thuận, okay, I see you raising the hand. Yes, Thuận.
So I think that the free cash flow for the equity is negative. I don't think that is the best sign for the company because they are trying to expand their business. So that's why they need to invest more in the acquisition, also the equipment. And due to the opening a new store, maybe there's some cost for the first time they cannot cover. So that's in the loss, but it's just the short-term problem of the company. And maybe they will create a more shareholder value in the long run. I think so.
Okay, right. Thank you, Thuận. So this is very good answer, right? So remember, when you want to like evaluate whether we have a negative free cash flow to common shareholder, is it good or bad? So you need to pay attention to the timeline. Okay, is it just only for the short run or the long run? Okay, if it is just only for the short run, so thing will be all right because later on the value will be created for the shareholder, right? Because that kind of investment, right? Later on we will know that whether it generates more value to the company or not. So we will base on the cash flow statement later on. Okay, so here, right, just only a short period of time from year 3, 2019, sorry, 2009, and then 2007. So it's just only like the first phase of investment, and then we haven't recognized any like value to the shareholder. That's why later on we can recognize those value, right, as when the company utilize the benefit from this merger and acquisition transaction. Okay, so clearly that is not like clearly a bad sign for the company through the investment in like the merger and acquisition transaction, but you know that later on, right, that will create more shareholder value in the long run. Okay, so here that is the conclusion. If free cash flow is negative, it is a sign that the firm will need to raise or earn new equity, but not necessarily immediately. Okay, so later on, if this problem keep on happening to the company, so it mean that the company is in a bad financial situation, but it is in the short run, so you don't have to care worry much about that. But instead of that, you need to have a look at the cash flow statement to see that during the year, is there any kinds of investment made by the company that use a large amount of cash, and then does it investment contribute the value to the company? Okay, so we can evaluate that given a longer time period, right? Not just only for the short run. Okay, so that's just the explanation for question 12.11, right? This is just what I say is right here, more than 3 years longer, and then we have any benchmark. All right, so I see the question from Ang. All right, so obviously for me, 3 years not considered to be long run, because you see that from the information that we have here is for, okay, let me share the screen again. Dick's Sporting Goods, right? So they start to invest in 28, right? In 28. So it means that this kind of investment just started in 28. And then if you want to know whether this kind of investment bring value to the company, so you need to examine right from the start of the investment point later on to 5 or maybe 3 years, okay? Because this is just the beginning. And then you just know about the performance after that investment around 1 year in 29. Okay, so that is not enough for you to know that this kinds of transaction bring the value to the company or not. Okay, we do not have enough information to do so, because we need to examine further, right? Everything needs time to be reflected and then to be to show for to be available in the market, right? Including the value, the benefit. So you need time to prove. Okay, we need time to prove, and then similar as any kinds of company. Okay, so just pay attention to the starting point of investment 28, and later on we just have the data for 29. So those information are not enough for us to know the negative cash flow is the bad side for the company. Okay, we cannot prove anything from that. Okay, all right. Okay, so that is for question 12.11, something that you may notice here. And then why this is important, because there are something that you may don't pay attention, that is operating liquidity. Okay, one sentence here that is important is that, right, this company require all of its cash equivalent from operating liquidity, the balance in the operating settlement account, and then report no interest income statement. Okay, this means that if they have the cash, right, they will require all of that cash to maintain the balance in their settlement account for the operating liquidity. This means that they don't want to hold any cash available, so that's just the cash they have just for the operating liquidity. Okay, that's why I have some notes here for you. Okay, and then why we have change in cash requirement for liquidity. Okay, is how you estimate based on this sentence, right, from the information of the tables. Okay, so I think that is quite clear for problem 12.11. Let's move to problem 12.15. Okay, 12.15, we have two questions. Two sub-questions, A and B. All right, so the first one, question A. Let me see. All right, so here, question A. Clearly, the thing that we have is that calculate the value of equity for this company. All right, so if you remember, this is the kind of exercise that we practiced previously, okay, about the company of adding gas store or do not add gas store to their production line. Okay, so firstly, ignore the mid-year discounting and just estimate the value of equity as of beginning of year A under each of the four scenarios. All right, so stop share. And then I will see that anyone here raise a hand. All right, so I see some of you raising the hand. And I will call one of you to answer A and then the other for B. Okay, so firstly, Mai Phương from group 1 to answer A because you raised the hand first. Okay, Mai Phương, I haven't called you, so I will call you. Mai Phương.
Can you see my screen?
Okay, we can see your screen.
Okay, so I'm gonna do question A. We're basically gonna copy this entire table down here. And to estimate for year 8 onwards, we're gonna, year 17 onwards, we're gonna have the value of year 17 divided by the cost of equity minus 10%, because we have a 10% growth after year 17 for the best scenario. For the most likely scenario, we have a minus of 5%, same equation. And for worst and no gas, we have no differences. Okay, so for the present value, we calculated the same way, using the value from the main table divided by the 1 plus the cost of equity to the power of 1, or in this case, 8 minus 7. We do the same thing for everything else. For the best case scenario, most likely, worst and no gas scenario. And then the following years are just the same, all minus to the power of the year minus 7. And the same thing for after year 17. And then to calculate the value of equity of MSC, which is gonna sum everything from the best, we sum everything from the year 8 onwards to after year 17. That's how we get this number. And this, we done the same thing for most likely scenario and worst and no gas.
Okay, right, thank you, Phương. Right, just stay there. All right, so can you go to the line 46? Line 46, the third B column, right? B46, okay. So A46, A, and then minus 7. All right, so A minus 7, so it means you discount it, right, for 1 year, okay? All right, so I agree with this part. And here, so the thing that I find is quite different from my estimation is for the terminal value, okay? The terminal value is when we have after year 7. All right, so you have 17 minus 7. 17 minus 7. So can you go to B40, sorry, 56, 50, 55, okay, 55, B55, right? The upper one. Okay, so A55, what is A55? 7 and then minus 7. All right, just stop there. I need to look at this clearly. All right, so you got the correct answer here for the present value of year at the end of year 17. But after year 17, B43, okay, B43, this one. B43, okay, B43, 10%. All right, just stop there. I will need to have a look clearly. See, B42, B42. Okay, all right, see what is meaning right here. Right. So you know that for the all right, so it means that if you forecast the cash flow from year to year, right, given the growth rate, so you can easily estimate the cash flow. However, the thing here that may like make you to have the mistake is the terminal value, right? It's the terminal value. It means that the cash flow after year 7, okay, because we assume that after year 7, the growth rate will be constant. It means we apply the perpetuity like constant growth model to estimate the terminal value, right, after year 7. Okay, so P42. Okay, P42, right? Just give me a second. I will need to look carefully. Multiply with 1 plus 10%. Right, multiply with 1 plus 10%. So why don't you multiply with 1 plus 10%? Because after year 17, the growth rate will be 10%, right? So it means that if you want to discount the terminal value, you need to multiply with 1%, right? After year 11, sorry, 17. The cash flow will grow at 1 plus 10%. Okay, so P42, you need to multiply with 1 plus 10%, and then overall you divide it by okay, so this, right, P43. Okay, go to P43. Okay, here for the formula, right, just go to the formula P42. P42 right here on the formula. Oh, okay, sorry, P43 is correct, but just go to the correction. Okay, can you click on P43, and then, okay, so go to the formula. All right, okay, so P42, right, just stop at P42. You need to multiply it with the 1 plus 10%, because that will represent the cash flow like after year 7. Okay, so overall you divide it by, okay, so this is correct. Okay, so it should be 33, like approximately 33 million, right, for the terminal value. Okay, so you need to pay attention to this part because that will affect to the terminal value. Okay, you do it similar for the case of most likely worse and then no gas as well, right? You need to multiply the cash flow after year 7 with the growth rate. Okay, so I think that is pretty good for the question A, right? Thank you, Phương, right? Just need to have some correction, and then your report or your assignment is good. Okay, so let's continue with B. Okay, so I will call Han. Han, please.
Okay. Okay, here, so I will answer the question B, that this valuation affect my advice for management of MSC or not. So as you see, the most likely scenario provide a value for this company is approximately 3 times larger than the firm if they does not add gas stove, and the wood stove market appear to be in decline and the gas stove market growth. So in a scenario that if the probability of the most likely scenario is approximately 30% or more, then the expected value of adding gas stove will exceed the value of not adding gas stove.
Okay, right. Thank you, Han. So you have some idea right here. And right, this is an example about the risk analysis that you should consider for the real estate projects, right? For the scenario analysis, means that you consider different scenario happen to the real estate, the best case, the likely case, the worst case, and then the other case as well, right? But mostly 3 cases, the best one, the normal case, and then the worst case, right? So it's given the growth rate to be different. So what happened to the cash flow or the value of equity as well the value of your real estate projects, right? That is kind of the risk analysis. Okay, so clearly the most likely case is the one that you need to pay more attention because that is the case that tend to happen in the reality. And then the probability, it should be higher compared to the best case and then the worst case as well. Okay, so if we have like if we allocate the probability for the likely case, for the worst case, and then for the best case to be equally to each other, so it means that that will affect to your decision of adding gas stove or to not adding gas stove. Okay, if we have the probability of the likely case, like Han just said, it tend to be larger and larger. So it means that when the company that just adds gas stove, so the value added to their equity will be significant, and then it's almost like double, right? Triple the case without gas stove. Okay, so that's one you should consider, and then you know that to like have a clearly or correct answer. So you need to conduct a risk analysis, and then you need to run like you apply the probability calculation here for different scenario as well. Okay, so here right clearly you know that if we just allocate the 30% of the likely case, so which means that the value of adding gas oil to be like exceeds the value of not adding gas stove. So it means that the company, they should choose to add gas stove. Okay, right? If they have the probability to be 30% for the likely case. Okay, right. So that's something you should think about for the question 12.15, 12.11, and then something that you need to pay attention for your group projects assignment. Okay, so I just share with you the content, right? The thing that you need to start writing from now. Okay, so right, just start to write for the group report, including the market situation, and then the introduction for the selection projects that you choose. Okay, and later on, right, if you choose the market comparable, so you need to have the backup by finding information and then finding at least 3 comparable to make your comparison to be like trustable, at least for me. But maybe for Dr. Duck, right, he requires more from you and Dr. Kim as well. Okay, right. So I think this almost like done for today's section, and then you will have some minute break before you jump into the discussion with Dr. Kim for the case study. Okay, so see you all in the upcoming section, and then I hope to receive the submission from group 1, 4, and 6 for your selection projects. Okay, so just send me by today. All right, so see you all. Goodbye. Okay, goodbye.
Get everyone discussing about the property project. Yeah, we intended to have a guest speaker as well, but probably next week or the week after that. Yeah, last term we have a very outstanding speaker in the industry and also from the academics in Australia. So yeah, I hope that this term you will also have more insight from more guest speaker. All right. So by this moment, I encourage that in every session we have some discussing regarding to our case study, and then we can also have some information or some discussion about the property project. Yeah. So by this time, if you check on the e-learning resources, you may have received some information in advance to get ready preparation for your project, right? And I believe that Ms. Lin already informed you how to and procedure and also the timeline to submit the interim report, the progress report. Okay, so by which we can also assess your work in progress. It's not one time, but it is a journey how to get into that. Okay, so today now we will do the case. If I'm not wrong, is it the Starbucks case? So I suggest that as usual we will have 6 groups. Can I ask one group to prepare, say a brief introduction, what the case is about, yeah, and what your group plan to discuss about that. Okay, so I will expect in this case today that we have more discussion about what we can assume, yeah, in the scenario, because remember that the focus is heavily depend on what you expect in the assumption, right? So the assumption and what you believe is very important to set the foundation for the forecast. All right. So Any group want to volunteer, or I will pick one group by random. Any group? I will take group 3. Anyone represent for group 3? And can I ask that everyone turn the camera on if possible? Because I don't want to feel that only me and a few people. Yeah, group
Hello.
3, please. Yep.
I'm hopeful for group 3.
Okay.
So I will share my screen. Can you see my screen now? Can you see it?
Yes.
Okay. The case 7 and 8 is about the valuation for the free cash flow of the for common equity in this assets. So it's like similar to the previous case study with the Starbucks financial statement about the income statement, balance sheet, and the cash flow statement. Yeah, also the sale analysis. So the difference from of this case study with the very previous session is that we will apply the valuations for the common equity shareholders based on our forecast, the forecast value. So I will turn to our work about this for the calculation home preparation. So this is our sheet about the forecasting activities. In this, from the last lecture, where we have conduct again our forecasting activities. So we have to begin from the forecast development with the like the number of stores we will open in the next 5 years, and like in the sale per every store. So then we multiply them to get the total revenue forecast for the next 5 years. So here we have seen that over the already 3 years, the company for the like 3 reasons have the trend of increasing over years significantly in the 3rd year. So we have based on the average point of the 3 previous year for the first forecasting year with the total new open store, and then we add some like 20 more, 10 more, and for the next year. So we sum it to have the total store. About the sale per every store, we have like reduced 0.1% per year, and then we multiply it to have the total revenue growth rate is this yellow line. This is the forecasting revenue growth rate. And when we move to the forecast for the 3 sheet, like income statement, balance sheet, and cash flow, this is it is the same. Here the revenue we have taken from the forecasting development sheet. We forecast it for the year 6. It is set from the case that on the year 6 value is the growth rate is the 3% of the year 5. So we just multiply with 103% for the value. But for the income statement, there are some account like the cost of goods sold we have based on the previous common size to get the like the common size for the 5 years forecasting. And our assumption is just that like forecast based on the average point of the 3 years, or seeing the trend of the previous 3 years to assume for the percentage, the suitable percentage and then we get the final result here. Apply for the balance sheet. Well, as we read the textbook, they provide two methods. Like the first one, like we will apply the turnover ratios for some items such as the cash ratio, the account receivable turnover, and inventory turnover to get the number for forecasting. Also, we have rely on the average point for this. Let me find the asset turnover. For example, the cash turnover about the day of sale, we have that increasing trend. So we have take the average is about 30 days for using the forecasting here, the 30 days, and apply the formula to get the cash and cash equivalent for year 1 to year 5. And then another method is like the item like marketable security. It said that we can apply the growth rate as the revenue growth rate. So we put the revenue growth rate here for the value. And after doing some forecasting for the total assets, liability, and equities, we have checked again the balance of the balance sheet. And it's a bit hard to make it like balance at 0% in the change. We have like this number, the difference between the total asset and the total liability and equities. For the because we have applied the tools, so it have provide us some like the formula that's already have, and also the valuation sheet. We just put the number, and here this is the cash flow for common equity. Yeah, the number is taken from the two previous sheets. For the common equity, the free cash flow for common equity, we start from the operation cash flow. We minus for the investing and the debt financing. So this is the free cash flow. So next we discount to the present value and sum it. This is the net present value of the first 5 years, and in the continuing value, it is the value of the 6 years and the years after that. Then we sum up to the total value, the total net present value of the company. Then we divide to the total of share to obtain the value per share, as the case requires us to do here to compute the value per share. Also for the free cash flow for on debt and equity, we also apply the same method, discount to the present value and calculate the value per share. And that is our work for the case study, which is the preparation at home. Yeah. This is the end of our preparations.
Everyone, did you all enjoy the presentation? Thank you, Fu. So everyone, you now can share your comments, your feedback, or even your different work as well. So what is your opinion, everyone?
Can I ask you about how you can get the value of outstanding debt, because it's quite different from our work?
Mm-hmm.
Wait a minute. outstanding debt.
Yeah, 260 line 260.
260. Hay sao gửi đây F39. Wait 39. Wait a minute. It is the sum of here cash open them. And this out. Short term maturity. Yeah, it is like the long-term debt in 2020, in 2012. Yeah. The outstanding debt is the sum of like the short-term debt, the current maturity of long-term and the long-term debt. However, in our case, the short-term debt and the not payable and current maturity is 0. So we only include the long-term debt for the outstanding debt, and especially in the year 2012 is 550. Yeah. Just that.
I'm not sure about that because I take the this value from the note in the question, and I don't know whether it's right about the. Is there anything wrong about the calculation?
About the calculation, I don't think it's wrong because this is like
Can you open
tool.
the question? Can you open the question?
This?
The question is at the note.
What? Open what? Can you repeat?
The question in the textbook.
Yeah.
And there's the note part under the income statement or the financial statement.
Here. Oh, wait. The note part. There, here.
Yeah. And I see it has shown us some information about share outstanding and the share price and etc. And it's different from your work. So.
Oh yeah. The number of shares here is 749.3 exactly. Here is the number of debt outstanding. Outstanding debt is minus 550. About the number of share is also we apply in the textbook is 749.3, and the current share price is also 50.15.
Oh, okay. My bad.
Oh, no.
So anyone asks about the procedure of doing the forecast? Can I ask what is the first step of doing forecast? From the very basic point. Yeah, we try to do something very basic, very theoretical, right? So from beginning, what do we base to do the forecast? What is the first thing we do the forecast?
I think the very first thing we need to forecast is the revenue.
Yes, we start from revenue. Very good. So how do you forecast the revenue? Sales.
Yeah, we in Starbucks case we have based on the sale. Specifically is the number of new store open and the sales per every store. Then we multiply them to get the total revenue.
Yes. So do we use the forecast for the year plus one? Do we use that? Anyone raise question about the figure of the sales forecast for year plus one? Do we use that information? Remember that when we do the forecast, at first we need to use the information. Say the scenario in this case, what the board of director, the board management plan. Say they plan that they will have how many store open, how many shops they want to open. Yeah, so we have to use that information first. Anyone raise question from this point? I feel that your figure is not doesn't follow the information. They say year one, it must be some few hundred, 300 or something new store. Do we use that?
I think this is also the first problem when we're doing the forecasting, because when we read the case, we have like it is just like provide information about the information, the numbers for we doing the valuation, but the forecasting about the number of new store open, I do not see it in the case. So about the number of for number of new store to open, like it's difficult for us to do the forecasting. So in here we have those like choose the number like the average number of the previous 3 years, and then we add about the fixed number like 20 or 10 and 10 in each region.
That is the very serious problem. Okay, can anyone find out the plan new store they plan to open for the next 5 years? Can anyone help in this case? How many shop, how many store they want to open?
I think that's there's a note in the case that they have mentioned it from the management guidance. Like this, from year one, they expect to open 300 O and 300 licensed store in Americas, and 200 O and 400 licensed store in China and Asia Pacific segment, and 34 O's and 66 licensed store in Europe, Middle East and Africa segment. Yeah.
Yes. So everyone, please, when you do the forecast in whatever thing, you know, you need to use the most accurate, yeah, as much accurate as possible. Because if you use your own imagination, then the result will be just, you know, in your imagination. It is not accurate to reflect the reality. So in this case, we have to try our best in reality to reflect the reality. In this case, we better use the information, whatever we have. Say, for example, when your boss gives you something like this, your boss say, okay, you go and do valuation of the equity security, equity stock of Starbucks. In this case, you have to start from scratch. You have to estimate the cash flow in the next 5 years, yeah, and beyond 5 years. So at first you have to use some assumption, and you need to use as little assumption as possible. The less imagination you use, then the more accurate your result. Okay. All right. So yeah, is Kiều Nguyen. Are you in the same group with Fu?
No, I just said it for them.
Yeah. So anyone can we share the? I appreciate that group 3 you try your best, but we learn a lesson. Okay. Everything we all make mistake, but next time don't make the same mistake again, especially in your project. Try to reduce as much your imagination as possible and use the real figure in reality, right? You can't just use your imagination in anything. All right. So in this case, we start from sales. I agree. But the sales plan is that in next year, how many stores they want to open. Yeah. And they also give us some information regarding to the prospect of each region. And we, as I say, if we understand the industry, then we can have the accurate forecast in terms of the new store. Okay, so any group can share your work. Other group, I mean, can share your work regarding to the forecast of sales. I try to find to see all of the group works here. Okay, on the 6th group, you better show your work so I can see how you work. Right, so thank you, group 3, and now I'm looking for other group work.
Thank you for your
feedback. Yeah.
Thank you for your feedback.
No problem. Next time, yeah, learn your lesson and try to work better. Okay.
So we share on this chat or we mail you, teacher?
So Nguyen, yeah. Is that Nguyen? Do you want to share your work? Other group? Group 4? Can I ask group 4?
Yes, we share you on the internet or we send it via the chat or we send it via mail or we just share straight.
Yeah, we can share on here in your presentation. You just briefly present your work.
Yes,
as I say, we try to defend, we try to discuss deeply in this case. Okay, we learn from little thing. Say how we use the information. Yeah, so at least you learn some error here and you try not to make it again in your project, in your real work. Okay?
Yes, teacher, let me share screen.
Sure. In this case, just remind you that when we apply this to property, if you are given a property to do valuation, then you have to investigate about, try to collect as much information as possible, like Starbucks. You have to analyze, but to analyze and you have to collect lots of information. Okay, and now, okay, group 4, you ready?
Wait for me a minute.
Yep.
This is our forecast development. From yes, this is our forecast development from so I think it's a little similar to previous group, if I'm not wrong.
Can you do slowly? Can you show how you develop your forecast? You
Yes.
forecast from what background?
Yes.
From where?
So first one, we forecast a company operation from age 17 is here. This
Can you
company,
show us the particular region? How do you start from the region, the free region, right? America, EMEA, and the CAP.
okay,
Imagine if you are presenting this to your boss.
yes.
And your boss have no idea about any figure. So just tell them, just present to them in plain language, how you persuade them. Otherwise they will turn your paper into the bin. I tell you what, some of the boss, they just have very good business mind. Yeah. But yeah, sometimes they are not very patient. And if they see your paper have no value, they will throw it. They will, yell at you, shout at you. They throw it.
So we based on a total operator from 2012 to forecast 2013 to common net value of company operator, and from company from license store is the same. We use total up on CGP.
Where's your number of store? How do you forecast the region revenue, region sales? Okay, so from the sales, you, yeah.
From this sale here, from number of store, we wait for me. From this data, we calculate number of total revenue from here.
Everyone, please pay attention and raise question as well, okay? Can you show me your sales? How do you forecast the sales again? You know, because the sales set a very basic point. Yeah. Sales set market prospect. Okay. So I want you all to have as most accurate sales figure as possible. And from there, you can set anything, the next stage. So here from sales, we have to start from the number of store. And here we have types of store, right? One is the own and operation store, and the other one is license. Just like Trung Nguyên, right? They can sell franchise their name, so they can earn some of the, say, commission or material, etc. from them. And they also have other type of business regarding to owning and running their shops. Yeah, so we have to set those kind of business in particular. Yeah, so each region will have a number of store by types, and from there you can set the sales. So the number of store is the plan that they will open, and each store we will have the accurate, the estimated of the sales per store. Okay, the sales per store, and then we have the total revenue. Okay, total revenue based on each shop and each region. Okay. So anyone have any problem at this stage? Anyone, any other group agree with this result? Or do you want to raise any question? Want to remind all of us about something in the sales? Remember that from the textbook, they only give us the forecast for 1 year, yeah, for year 1. And they also say that they will set in the next 5 years, how many stores they plan to open. And they also give us some information regarding to the prospect of each region, okay? So, if they give us very clear information about the prospect, the market prospect, then you can guess based on that, the market feeling, yeah? And beyond that, you can use your own judgment. If the market will grow how much, by how much, you can use your own judgment, okay? So that will be the basic point. So if you present this to your boss and then boss say that, okay, I plan that the next 5 years, it will grow by this much %, okay? And then you can adjust the market growth by your boss feeling, okay? And say if you are external valuer, analyst, then you can use as much information from the external, from other competitor, from the industry. You have to read and you have to collect all the information because of that, so that your forecast, your valuation has more value. Okay. Otherwise, they don't care about how brilliant you are. If say you forecast that next year it will be something else, and it turned out that it is not accurate, then you have no value. Doesn't matter how brilliant you are. Yeah, because in the end they just see what you mentioned, what your opinion about something. Okay. Yeah. So I think I want to see other group who can present more. What to say? In more, some group can show us the whole story. I think this is very hard because it is not only that you are a good presenter, but you have to understand the case, and you need to know the story. Seems good presenter and a good storyteller in this case. So anyone want to try? Come on. I see there are many talents in this class. Just show us. Anyone? Just try. How about group 2? Can group 2? Yeah.
Teachers, we are group 2, and we have presented our forecast last week. So up to now about the self forecast, we do not change too much. So we need for last week, yeah, for the last 2 weeks.
Okay, I see. So what? Sometimes use our sense as well. Yeah. Try. For example, item you can make emojis. So try something as simple as possible. Okay, don't make it too complicated. That makes you, to fall into the technical too much. All right. If you can use a more simple one, but it also the same result, then use it. And in any forecast, just use your assumption. Why you have that? Why you show that? Okay. So I think that okay. Group 2. Do you change anything, or you have the same result as last session?
Actually, we have changed a little bit about the balances because from the last time you have mentioned to us that about the balances we have the problems when we make the balance sheet, and also we identify the cash flow and move on with the case for this week. Yeah.
Yeah. Okay. So maybe I will ask group 2 to present in the end. Okay. Can I ask group 1? I don't forget group 5 and group 6, okay? Every group will show us your work as well.
We are group 1, and can you see my screen?
Yes.
So our group will start from the forecast of sales with each regions. About America, we as the notes in the textbook, they say that the Starbucks will open 300 new store in the year +1. So we assume that each future year, Starbucks will open constantly 300 store, and we assume the growth rate of the revenue per store is constantly at 5% because the America is the a tri-large market and a similar market of Starbucks. So 5% is a suitable number for Americas. So we calculate the revenue for the total store at Americas by use the forecasted revenue per store multiplied by the average store per year in this year.
Mm-hmm.
So in terms of Europe, Middle East, and Africa, we do the same thing, but the assumption for the growth rate is 1%, because the market for Starbucks here is also try small at the moment. So we just assume they will grow at 1% constantly.
Can I ask one question? Sorry. Sometimes I want to ask immediately, otherwise I will forget. Yeah. Any other group agree with this forecast? So at first here we have the number of shops, right? And then, okay, we say that next year I want this many shops to open, and in the next 5 years as well. So we have a horizontal view over 5 years. Yeah. And then we say, okay, year 1, 2, 3, 4, 5, this many shops. And then we estimate that, okay, each shop will have this revenue. Yeah. And we say that, okay, target in average, each shop has this. The group 1 say that we plan 5% growth rate for America. Any other group here ask why 5%? Any other group suggest other percentage growth rate? I'm just asking, yeah? And you can say anything about that because it's the forecast. And we are trying to convince boss. Yeah? And imagine if you say 5% and boss say, why? Can I ask another percentage growth rate? So what is the common sense here? Okay, or even if boss saying I want 6% or I think other percent, then how can we convince boss? I'm just imagining something because, say for example, when you do forecasting, you have to ask yourself why we use this figure. What is the solidity for this? All right. what is the concrete evidence when we use this number 5%? Why? So we better understand the root of each figure, so that in the future you can develop your own forecast, your own judgment. And I want you all raise question and find the answer. Can anyone show me, give me some solid response, as solid as possible, right? Okay, so Nguyen say that it is the inflation. Any, right, so anything else? Any, inflation is one reason, so we guess that the inflation will be 3%, so just a little bit higher. But why revenue will grow by that much percent? Okay, so I will just raise question and you guys think about that. Or one, can you move on in your work?
So in terms of China, Asia and Pacific, we assume the growth rates will be decline over year from 12% to 7%, because this is an emerging market with fierce competition between many brands in the penetrates. Therefore, along with the increasing, Starbucks will witness decreasing revenue growth rates in the next 5 years. So, after that, we will have the sales forecast for year +1 to year +5, and the requirement say that in the year +6, all of the items in the income statement and balance sheet will grow at 3%. So we multiply the year +5 with 3%. Forecast. Yeah, here. We multiply the sale of year at year +5 to 1.03 to get the sales of year +6.
Actually, if after year 5, if you say that the growth rate will be stable at say 3%, then you don't have to do too much about that, remember? Because after that it will be say forever growth rate. So yeah,
at year +6.
yes, we can start by then.
Yeah, and we calculate the other items in the income statement, such as cost of goods sold, based on the common size. We assume that the declining, the cost of goods sold will be declining as a percentage of sales, because with the longer time of operation, Starbucks would adapt well with the local environment and would find suppliers who provide cheaper materials and could find ways to reduce the cost of goods sold. So here it it start from the 4 to 42% at T+6. So, and all of other items will be constant as the percentage of sales. It is similar to the first 3 years.
Yeah.
So about the interest income, we assume that the interest income will be grow as each year the interest income will be 10% on the average marketable security.
Yeah. So the interest income will be, you have to base on the marketable security from the balance sheet, right?
Yeah, it's here. Market.
For the year before or the current year? How do you calculate the interest income?
It will be 10% on the average between the current year and the last year before.
Okay.
Yeah.
Everyone raise any question? Or anyone want to have more explanation? Why? Why you have to take the year before and the current year?
I think that we could explain a little bit about interest income. So at first, to calculate the interest income, we need to have the financial assets at this year. So it means that we need to move on with the balances in advance to calculate first a rather amount of cash and short and long-term investment on security to have the amount of the financial assets. And next, we have to calculate the return on financial assets based on the assumption, and then we will use that two number to calculate the interest income. So it means that I think that we should move on with balances before we calculate that measure. Yeah.
Right. You are right. In this case, if you want to put the notes and anything that you better put a note how you calculate and what assumption it is. Say, for example, for the short term, or say on the marketable security, how you will earn the interest. Okay, you need to base on that assumption first. Even you have to put a note yourself. Say the security, the marketable security will be based on, say, the dividend or something. Then you estimate that will be the based on the current marketable security, right? But because you may think of say the average between the current year and last year, because the interest income will be, say, after 1 year, right? Or you have to base on the assumption on in what information you have. Say how they will pay you interest after 3 months or how. And if you have more information about that, then you will set a formula here. Okay. In this case, I will just assume that you will have the interest based on the average value of the marketable security. And the average will be the middle of the beginning and the end of the balance sheet value of the marketable security. Okay, so that explains why we use the average here. We take the beginning, beginning means the end of last year and the end of this year, right? And that is the average. And if you estimate 10%, then that will be 10% of the average. Okay. So yes. Again, Cường, is it Cường? Yeah. You can assume something as well, but the interest income, the interest rate, yeah, the interest rate or the return rate from the marketable security is also something you are not sure, right? So we can move on by say you assume that will be the interest will be say ranging from this much to this much. So by which you can estimate that the interest income will be this average. Yeah. Of course, this is our best forecast. And when we have more accurate information, then you can have a more accurate status. Okay. So anyone else want to contribute into the calculation of the interest income? Here we try to develop, try to explain how we base, how we develop the forecast, yeah, so that you can also imagine what component can fit into what, yeah, like you say, sometimes you can forecast the amount of the security value in your balance sheet, yeah, but even you forecast that, you still are not quite sure the interest or the return rate of that. So the income will depend on two factors, the value of the asset and the interest return, the interest rate on that asset as well. So here we can say, we can estimate one lump sum because we don't know the two variable here, the value of the asset and the return on that asset. Okay. Okay. Can we move on to the next component?
So about the tax is based on the requirement in the textbook, that is 33% each year. So we come so after calculate and forecast on the thing, we results in a comprehensive income, and that is the end of the income statement. Move to the balance sheet. About the cash, because Starbucks sell coffee and receive the money immediately, so we assume that the cash will come from the revenue at 9%, and other source of cash will used for the capital expenditure of investing new store? So the marketable security will grow at 3%, and we take 50 days to collect the cash from the customer. So we assume the 15 days sales here, and we assume that 70 days for the cost of goods sold is calculated from the days we purchase the raw materials from the supplier, and from to the days to the day Starbucks deliver coffees to the customer. So it takes 70 days. About the accounts payable, we assume we take on average 1 month to pay the cash for the suppliers. And one important thing is that we assume 40% of the net income will be included in the retained earning here. So we calculate the retained earning in this year by use the retained earning at the beginning of this year plus 40% of the net income in this year, and we have the total liability and equities, and here is the check figures between the total assets and total liability and equities. It is not much vary here. So the moves to the statement of cash flow. I think most of the item from the operation, from investing or financing, will result from the all of the numbers in the balance sheet and income statement above. So can we jump into the FCF calculation, teacher?
Yes. Anyone has any question? Yes, good.
I have a question about the balance sheet. So, why do you think that the cash and cash equivalent is take around 9% from the revenue? Yeah. I mean the logistics part proportion.
Group 1 and other group as well. If that question is for you, what can you answer? Can anyone try to convince? Can it be some percentage? Anyone try to give some explanation of 9% of cash on revenue? Why? Just try to convince boss. Come on, you're very good. And say, if your parents say, why you need this much money? And you answer. If your parent asks, so if you can't answer, then just say, because I say so. Because I need that money. Can we? One of the simple answer is that statistics say so. Okay, you can use the average of the 3 years in the past. You can use the industry average. Okay, you can say that the industry is about this much. It means that to operate efficiently, the company needs some cash to maintain the need to pay. Okay, so if you want to raise revenue, you need to reserve some cash so that the company can help when it comes to need to pay something. Otherwise, the company will be in trouble for liquidation. Okay, so you need to go back and you do some statistics. Say the simple one is just to use the average of the 3 years, right? And if you can imagine something like sometimes the company just want to spare some cash, or the company can use that because it has some spare, and they can use to pay back the debt, pay back the accounts payable or something. Okay, but try to work harder on the ground how you have that percentage. Very good question, and also raise similar question when you try to develop other figure as well. Say, for example, why sales that much? The answer regarding to the sales will be who consume this kind of Starbucks? Young people, right? Of course, not so old people, as far as they can, they can walk around, they can go to a Starbucks shop, they can sit and they drink and eat and then enjoy, life. Right? So not so old people, they can always enjoy like that. So the revenue will increase according to the population growth rate. Yeah, so population growth rate is one of the root, one of the background to estimate the revenue. Yeah, the more the more population growth rate, then you can estimate how much it is. Even regarding to the email, here you estimate that it is only 1%. But if people convince that, by time, Starbucks will get more popular, yeah, and get more acceptance in European and those country in EMEA region, then the growth rate will be 2%, even will be 3%. It will grow more because they will get more acceptance, and they Starbucks become popular, become common, yeah. So it is just some example for you to think how it is related to something that we can estimate. It is just like you are a detective, yeah. You have to find out what is related, what is associated with something. And if you know that thing, then you can figure back to what you are looking for. Okay. Okay, so any other question? If it is not convinced, then defense me. Okay, and I'm happy that we can raise more questions. So the more questions you raise, the better understanding you are in the end. Okay, just raise question and try to answer the question. Any other question?
Actually, in our group we have concerns about how the way you can calculate the accounts and not receivable net. So you mentioned that you based on the total sales and assume the 15-day sales. I have the concerns because you have mentioned to us that Starbucks is like the FMCGs. No, I'm sorry, like selling coffee and in the old stores, we think that's because it is not like the question is like that we have the different perspective about that. So we think that's about the account and not receivable net. It was mainly based on license and also the GCP's products compared with the old store. So we will just like check the sale from the GCP and license store to calculate the account and not receivable net, because we think that's at that time of store and product, they will allow for the credited sales. However, for the own store, it will be mainly based on the cash. So how do you think about that?
Yeah, very good. I try to explain one thing, that even at one point we have so many assumptions, right? And our job is we have to our job is, you want to go to sleep? Our job is, don't lie down there if you want to. Our job is we have to narrow down the assumption, whatever is the most accurate one, yeah. And what is not very convinced, then we will eliminate, yeah, we will drop it out. So in the end, say for example, regarding to this, you will say that I think this one may not be so convinced to me. Okay. So for the account receivable, we try to understand the industry. So the industry, Starbucks here, they have two types of business, right? One is the own operation, right? And the other one is license. And who do you think they will owe us? Can a customer come into Starbucks and buy a coffee and say, hello, can I pay it in 45 days? We sell one coffee for them and collect money after 45 days. No way. You pay by cash immediately, right? So there is no way that you have the account receivable in the shop operation. No way. Yeah. Always is cash transaction, cash sales, right? So the account receivable mostly come from the big customer, like license. Yeah, license, right? Because normally license, they will give you a report, say this month our salary this much. So sometimes you have to give them a period of time so that they can arrange payment for that. Yeah, so that is mostly license or franchise or big customer. When you say you process, you pack the goods, we call as what is that, consumer process good. Yeah, say you present the good on the shelf, and if they say that they sell it, so you have to give them a period of time so that they can pay to you. So that is the account receivable. So in more accurate, you can estimate the account receivable based on those segment of the sales, not on the total sales. That is the best accurate. However, in forecast, sometimes you can also allow some material, right? So like if it is not material, then not significant, then you can leave it, right? It is very common because sometimes if you spend like too much time on something, then you waste of time on doing something else. Okay, so that's why if you think that it is not very material, not very big, yeah, like in terms of percentage, then you can move on, and you make a note that this is based on what, but the even though it is not best accurate, but the significant is more, so we can move on with that. Yeah, and if someone else want to make more accurate, then they will do their calculation themselves. But we just raise some awareness that we know that our calculation is not the best accurate here, but it is more, so it's not important. Okay, so for the AR, I believe that the AR is only based on the license or the process package, consumer package good. Is so that you can sell, you can put on the partner store, partner sales or window, yeah, or franchise type. Okay, yeah, and any other contribution regarding this? Come on, I try to find out some brilliant student in this class. Give me some idea. Anyone contribute or defends me? Okay, no one else. Then any other question? Any other question? Okay, so so far we imagine that we do the sales forecast, yeah, and then we have the growth rate forecast for sales, and then we assume that from sales we have the cost, all the related costs to the business, like cost of goods sold, like operation expenses, and all of those we have to estimate, and we have to have some assumption, right? And the assumption is also important as your calculation. Yeah, as I say, your calculation, sometimes you just have to use some simple calculation rather than the complicated one. Yeah, the best one is the most simple, but the same accuracy. Yeah, that is what everyone knows. So regarding to the expense, you should also have some assumption. How much it will increase, like you said before. Okay, maybe with time the company will have more experience and will operate in more efficient level. So it will be reduced a little bit, right? But also we need to estimate and we need to be aware of other assumptions. If we have something, we know something, we should put it presented that we know this fact. And if this fact affect have some impact on our assumption, then how much it is, okay, we have to put that on. And that will also be the sensitivity in the future session. In later session, we will also discuss about the sensitivity. Like, say, if revenue is not that good, then how much it will affect our estimation. Okay, and this set very basic idea for your property project. Yeah. So in very brief, very limited time, can I ask that any of your group, any group set or find some information regarding to property? You can give me some question right now or share some information regarding of your property work. Can anyone? And again, for this case, I suggest that all of the group, after today, you will refine your project, yeah, your case work, and you will also submit that into submit to Miss Lin or on the or email, okay? So that we want to see your work as well, okay? And remember that you in the end, each stage will contribute into your work. So you can imagine you start from sales, then you move on to the balance sheet and then the cash flow. And if you have some imbalance figure, you have to see that is it because of the rounding error. Yeah, when you make round, then it will affect your balance or other reason. Okay, and in every figure, do you have any reason, yeah, any common sense reason to support that? Okay, so for the property, can anyone share with us your start working on the property project? Anyone? Any project? No? Cường?
About the properties, we have choose the project. So I think that we could say a little bit about that.
Very good.
So I would like to say about our project or group project. So in our project, we choose the Champion Dragonets. So up to now, they have not been like for sales, not for sale yet. So it is a change for us to have the valuations, and it was invested by Tan Thành Công Group. So here's some like overview of the properties, and this is like mainly served for the luxury segment in District 5. Yeah, and for the location that is in District 5 and in the main of three districts, Võ Văn Kiệt, Hải Thượng Lãng Ông, and Tảng Đà, and this is a river frontage. And here's like the map of the properties. Yeah. Here's like some information about the area, scale, and the building densities that we have collected, and also like the map of the department they have in the property. So, but however, this is the point that I want to we want to say, and also I want to ask is about this comparable project. So for the logic to choose the comparable project, at first we choose the project that have like the close distance with our properties, and we have like the criteria that it should be less than 3 kilometer distance with our property. So we have like up to now we have brainstormed 4 comparable projects. That is Hùng Vương Plaza, which have the distance is around 800 meters with Charmington, and they also serve for the luxury apartment like Charmington. And the second is Average Infinities. It have the distance around 2.3 kilometers distance, and also serving for luxury apartment also. And Dragon Riverside is around 2.9 kilometers, and Ventosa Luxury District 5 1.6 kilometer. And so we also have a question. That's because Ms. Len have mentioned to us that we just do like 3 property for comparable. So commonly we use based on the 2 criteria, that is like the distance with the project, and also like they serve the same customer segment, that is the luxury segment. So which are not the criteria that we should make concerns to like make it like the criteria to choose the most suitable collectible one. Yeah.
Very good. I think so far group 2 I think is the best one in terms of your group work and your presentation. I think other groups should also learn how you can do like this. I mean, so far, I hope that every group you have something best, something interesting to present. Okay. So in this case, you need to set say the question. What do you want to do in valuation? You want to value an apartment? What kind of apartment? Or you want to value what? You need to set from beginning because that is, say, imagine if your client, they come to you and they say that I want to say I want to buy an apartment from this project. Yeah, and your work is you have to value that. Yes, the question is very simple. Give me some price guide for this apartment. Okay, so if you say that, okay, today I have say a requisition from my client like this, and our target is to value an apartment from this project, and you need to collect all the information about this project first. This project has how many apartment, yeah, and its range like what, yeah, and you have to present on the geographic feature, on the say function, on the utility. What is the pros, what is the cons of this project? and then you can present the other project that you think that it is comparable. So you can present, say, a table or whatever, the distance, the similarity, and similarity in which, so you can make a tick. Okay, so you, of course, you can say you choose, say, 5 or so project or property, and then you can narrow down which one is better, or even you can take all 5, doesn't matter. Okay, or even from the 5 comparable project, comparable property, then you come into the, say, the price of each component. Yeah, say age, this one, and you need to have the price guide or the historical price of the comparable project, because that is the way you can compare. If you choose on the comparable properties that have no price guide, yeah, have no historical price, how can you guess? Okay, you should choose something that you have information, like it's already sold before, how much, and do you think that that price is should be maintained, or it should be eased down, or it should be higher? Why? Okay, so you take on the information about that, right? That's why if you present the whole story, the whole scenario of the project and the comparable project, and even the market trend, the market prospect, yeah, and then you can show your comparable one. Okay, and from the comparable, you have the price guide or the value, yeah, and then from that one you will say what approach of the valuation you choose. Yeah, say it is the price history, or maybe it is the income stream. Say, for example, if I want to value, appraise a house, a freestanding house. So what is the comparable property? Yeah, it is in the same street or just a few blocks away whatsoever. And does the property has some investment income, something like that, whatever. So if it has more positive feature, then it will have positive impact on the price guide. Okay, so the more information you have, the more understanding of the property, then the more accurate guess you have. And of course, imagine that your valuation need to be neutral. It is not your what you plan or what you think, but it should be based on the facts. Yeah. Imagine that you are not on the buyer or on the seller side. You should be neutral, and you just base on the market information, on the fact. Okay, don't use your don't use your personal or your favorite thing, right? So that is always use the science. Yeah, use the science information. And we will talk about this next week. Okay, and I believe that next week we will have a very outstanding guest speaker, he is a doctor, and he also has a very strong background in the property industry. He will share with you all the good thing. But remember, if you don't ask, he won't say anything. Okay, so please prepare your project, prepare for your information about property so that you can raise questions. The more inside questions you have, the more information you get back. Okay, so yeah, any other question?
Teacher, about the project. So our group choose only one apartment inside a large building. Is that okay? Or do we have to do an entire building?
Doesn't matter. Doesn't matter, because in the real world, if the customer gives you a small project, then you just have to do it. Doesn't matter big or small. If you show your diligent work, then you still have a good result. And if your customer appreciate on your professional work, yeah, so in this case, doesn't matter. You just have to provide a good one. Yeah, good work on that. Okay, whatever. We want to see your diligent work on that. That's all. Any other question? Okay.
So it's very difficult to find other information other than the basic ones. So other than the market comparable method of like valuation, then what other methods are like applicable for this project?
Very good point.
Much information on it.
I recommend that you can present some optional, like in the methodology of the property valuation. It can be, say, comparable. It can be income stream, you know, or the thing is, if you can find a comparable property, yeah, and what year it was sold, is it not too far? You know, so if you need to also to take a photo of your property inspection. Okay, even you have to do the diligent work regarding to what year the property was built and how it was, you know, it was used so far. How was its residence? So what is the region, like say any flood, any function utility around, like say school, like shops, like is it proximity to facilities, and security of the property. So it depends on the types of the property. If it is residence, then what resident want to live. If it is the business shop, it is something else, like industry. If one of you want to value, say, an industry property, then what is the important point for industry? What is the important point for the residents, if it is the residential property? Okay, so you need to find out the relevant figure, relevant features for the subject property. Yeah, because you evaluate the property, the subject property on the relevant feature, relevant information. Okay. Say if it is for the investment property, then how this property can be used for rent, okay, for business or for what? So what is it value? What is it valuable about? Okay, so if we understand the value of that, then we can evaluate it better. Say, for example, if you want to value, say, an old building, right? Of course, you will say that, oh, it is the level for property, range for property. So it is just a piece of scrap. Then you say that that property is not much. But if another person jumped in and they say that, okay, it is a piece of scrap, but I can renovate that, I can do blah, 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 and then the value will be higher. Okay, so if you don't see its value and you say that this is a piece of rock and its value is cheap, then you may be wrong. Someone else can offer a little bit higher and they can turn out the property into, say, a piece of gold or diamond. Then you see what error you have made. Okay, so it is just some of my idea regarding to your question. Yeah, so again, the more questions you raise to me or to other lecturer or to guest speaker, the more valuable information you get in return. Okay, so do then you will have a good report. All right. So I will let all of us finish here if you don't have any other question. And remember to do a good, diligent work regarding to the case, regarding to the project. You learn more, you will have more benefit in the end. Okay.
Can I have one more question?
Yep.
And about our project that I have already sent to Miss Ling, and she have replied to us that maybe our our project has already occurred for 8 years and it's a little bit far compared with some new apartment with the same rank. It's just like